Starting your investing journey with a simple one or two ETF portfolio is a smart move. But what if you could add a few key funds to that strong start, building a powerful portfolio that's ready for anything? Let's explore how to upgrade your strategy. Simple portfolios are effective, but a truly robust plan uses different tools for different jobs. In this video, we're going to architect that complete toolkit. I'll break down 5 essential Vanguard ETFs, each with a unique role, from a core engine and a growth accelerator, to an income anchor, a global diversifier, and a defensive stabilizer. I'll give you the hard data on each, and at the end, I'll show you exactly how to combine them to construct a sophisticated portfolio designed to serve as your blueprint for achieving financial independence. Every powerful machine needs a core engine, and in the world of investing, that engine is often the S&P 500. But what exactly are you getting with this powerhouse? Think of VOO as your foundational bet on American capitalism. When you buy a share, you're not just buying a ticker symbol. You're buying a slice of the 500 largest, most influential companies in the United States. You become a part owner of the titans that define our economy, from the technology we use every day to the brands we trust. For decades, this has been a winning bet on the relentless innovation and resilience of the United States economy. It's the raw horsepower designed to capture the broad growth of the market, and it has proven its ability to recover from every downturn in history and climb to new heights. VOO comes with a rock-bottom expense ratio of just 0.03%, meaning it costs you only $3 a year for every $10,000 invested. This cost-effectiveness, paired with the market's strong performance, has resulted in a 10-year compound annual growth rate of 13.60%. Its top holdings are a who's who of corporate America: NVIDIA, Apple, and Microsoft. However, this power comes with a critical risk: concentration. The information technology sector makes up over 30% of the fund. This means your diversified fund is making a massive concentrated bet on a single sector. This has been great recently, but it's a double-edged sword. When a sector becomes this dominant, it creates echoes of the dot-com bubble, where a downturn in one area of the market can have an outsized negative impact on the entire index. VOO's role is clear: to be the primary, low-cost engine for long-term growth, but it's an engine that needs to be balanced. Managing your portfolio shouldn't be guesswork, but most brokers hide the full picture. They don't include dividends, they don't factor in currency changes, and they definitely don't make tax time easy. That's where ShareSite changes the game. It shows your true performance, tracks every dividend, gives you clear diversification reports, and makes tax reporting painless. And with my exclusive link in the description, you'll get 4 months free when you sign up for the annual plan. Start investing smarter today with ShareSite. VOO provides solid market growth, but what if you want to hit the accelerator? How do you tap into the most innovative, fastest-growing companies on the planet? This is where you bring in the specialist. VUG is like a high-performance tuning shop for your portfolio. It doesn't just buy large companies. It specifically targets those that are expected to grow their earnings and revenue at a much faster pace than the overall market. These are the disruptors, the innovators, and the companies building tomorrow's world. If VOO is a reliable family sedan, VUG is a finely tuned race car. It's built for pure speed, designed to perform best when economic conditions are perfect. Investing in VUG is a high-conviction bet that these leaders will continue to outperform, but you have to be prepared for a much bumpier ride. This focus on aggressive growth has delivered stunning results, with a 10-year compound annual growth rate of 15.50%. It's also incredibly cheap, with an expense ratio of just 0.04%. Now, it's crucial to understand that VUG has a huge 57% overlap with VOO. So why hold both? Control. By adding VUG alongside VOO, you are making a deliberate choice to overweight your portfolio towards the growth factor. You're no longer just accepting the market's composition. You are intentionally tilting your strategy to capture more upside from the market's most innovative companies. Its top holdings are dominated by tech giants like Microsoft, Apple, and NVIDIA, and the technology sector makes up nearly 50% of the fund. This creates immense valuation risk and sensitivity to interest rates. Its role is to be a strategic tool, giving you precise control to overweight the growth factor in your portfolio, accepting higher volatility for potentially higher returns. Growth is exciting, but what about getting paid just for owning your investments? How do you build a reliable stream of passive income that acts as a defensive anchor in stormy markets? Meet VYM, the cash flow machine of your portfolio. This ETF isn't chasing speculative growth. Instead, it focuses on mature, stable, blue-chip companies that have a long history of paying out their profits to shareholders. Think of it as owning a portfolio of reliable businesses that send you a check, quarter after quarter, regardless of the market's mood. During a terrifying market crash, when your account value is plummeting, that dividend deposit is a powerful psychological anchor. It's a tangible reminder that you own real, profitable businesses, which can give you the fortitude to avoid panic selling at the absolute worst time. VYM offers a compelling combination of income and value, providing a solid dividend yield of about 2.9%. It has an expense ratio of just 0.06% and has delivered a 10-year compound annual growth rate of 10.46%, with a significant portion of that return coming from dividends. Its sector allocation is far more defensive than VOO or VUG, with financials, healthcare, and consumer staples leading the way. Top holdings include companies like JP Morgan Chase, Johnson & Johnson, and Procter & Gamble. The trade-off is that this fund will almost certainly lag during roaring bull markets. Its defensive nature isn't absolute either. Its heavy weight in financials was a major liability during the 2008 crisis. Its role is to be the income anchor, providing stability, generating cash flow, and reducing the portfolio's overall volatility. A portfolio focused only on the United States is like fighting with one hand tied behind your back. Are you ignoring half of the world's investment opportunities? This is where you break free from home country bias. VXUS is your passport to the global economy. It gives you ownership in thousands of companies across both developed and emerging markets outside the United States. You're investing in European industrial giants, Japanese technology leaders, and rising consumer brands in Asia. Many investors forget that market leadership is cyclical. The United States market was flat for the entire decade from 2000 to 2010, a period known as the lost decade, while international stocks performed exceptionally well. Owning VXUS is a strategic hedge. It ensures your position to profit, no matter which region of the world is leading the charge. This global exposure comes at a low cost, with an expense ratio of 0.07%. While its 10-year compound annual growth rate of 6.25% has lagged the red-hot United States market, it provides critical diversification that United States funds can't. Its top holdings include global titans you won't find in VOO, like Nestlé, ASML Holding, and Toyota. Its geographical allocation is spread across Europe at 40%, the Pacific at 25%, and emerging markets at 27%. This also introduces currency risk. If the United States dollar weakens, your returns from VXUS are magnified. If the dollar strengthens, your returns are reduced. This adds another layer of non-correlated diversification. Its role is to be the global diversifier, protecting you from single-country risk and giving you a stake in worldwide growth. Stock market crashes aren't a matter of if, but when. When the inevitable downturn hits, what part of your portfolio is going to protect your capital? Enter BND, the ultimate portfolio stabilizer. The purpose of this fund isn't to produce exciting growth. Its job is to be boring and reliable. It holds a massive basket of high-quality, investment-grade United States bonds, with a heavy allocation to the safest asset on Earth, United States Treasury bonds. Think of it as your portfolio's anchor in a storm. It won't make you go faster, but it will keep you from being swept away. When stocks are in freefall, investors flock to the safety of high-quality bonds, which can hold their value or even rise. This provides a crucial defensive line and a source of cash to rebalance and buy stocks when they are on sale. BND provides this stability at a minimal cost, with an expense ratio of just 0.03%. Its 10-year total return is 1.76%, reflecting its focus on capital preservation over growth. Its portfolio is composed of United States government bonds, over 60%, and high-quality corporate debt. But safe does not mean risk-free. The primary risk here is interest rate risk. Think of a seesaw. When interest rates go up, the price of existing bonds goes down. We saw this in 2022, when bonds had one of their worst years in history. Its role is to be the stabilizer, reducing portfolio volatility and preserving capital, providing the peace of mind needed to stay invested for the long haul. We've gathered the 5 elite components. Now, it's time to fulfill my promise and assemble them into a cohesive, millionaire-making machine. But before that, let me explain why this 5 ETF portfolio is superior to just owning VOO. Because it's built to win in different economic seasons. A VOO-only portfolio is a one-dimensional bet on U.S. large-cap stocks. This 5-fund portfolio is a multi-asset strategy designed to capture returns from different academically backed market factors. It captures U.S. market beta, VOO, accelerates it with innovation and momentum, VUG, defends with the value and quality factors, VYM, diversifies with international exposure, VXUS, and stabilizes with duration, BND. Since these factors often perform well in different economic environments, combining them creates a more resilient portfolio that has more ways to win over the long term. Here are 3 blueprints for different stages of your investing journey. The young accumulator, ages 20 to 39, aggressive growth, 40% VOO, core engine, 30% VUG, growth accelerator, 20% VXUS, global diversifier, 10% VYM, income anchor. This 100% stock portfolio is designed for maximum growth. With decades to recover from any downturns, the investor can afford the volatility to maximize compounding. We exclude bonds entirely to focus all capital on growth assets. The mid-career builder, ages 40 to 54, balanced growth, 35% VOO, core engine, 15% VUG, growth accelerator, 20% VYM, income anchor, 20% VXUS, global diversifier, 10% BND, stabilizer. Here, we dial back risk. The allocation to the volatile VUG is reduced while we increase the defensive VYM and introduce a 10% anchor in BND. The goal is to protect the capital that has already been accumulated while still pursuing strong but more balanced growth. The pre-retiree, ages 55 and up, capital preservation and income. 15% VOO, core engine, 40% VYM, income anchor, 30% BND, stabilizer, 15% VXUS, global diversifier. The focus shifts dramatically to defense. VYM and BND now make up 70% of the portfolio, designed to generate reliable income and protect the principal. This helps mitigate sequence of return risk, the danger of a big market crash right after you retire, which can permanently cripple your portfolio. You now have the complete blueprint to build a diversified 7-figure Vanguard portfolio. Which one are you building? The accumulator, the builder, or a preserver? Let me know in the comments. For more data-driven investing guides, subscribe and hit that notification bell.